Hello, welcome to Couples Create Cashflow. My name is Jordan Johnson. I'm your host. Today, we're going to do a deep dive into the world of velocity banking, and we're going to look at how a HELOC could be used on an everyday person's personal finances strategy to achieve some good wealth building speed, as well as looking at it as a tool to pay off debt. So today we're looking at a case study. These are loosely based on some real numbers from someone I was talking with recently. And I just wanted to give you kind of a how-to guide on how I would look at whether a HELOC could be helpful or not. So let's jump in. First of all, I just want to let you know that I'm here to help you. If you are wondering what velocity banking looks like or how to get started, or even how to even get a HELOC, I do have a free resource. It's a checklist, just a 3-step checklist on how to do velocity banking. Very simple. And it also now has a way to vet the different options that banks have for HELOCs. So I have a set of questions that you can ask a lender, and then some ideal answers that they could give you so that you can kind of start comparing options if you do decide to get a HELOC. So I've included that checklist as part of my guide to getting started. So both of those are available for free. You can find a link in the description below in order to get access to that. You do have to provide an email, but that's so that we can get the information to you. And by doing that, you are now on my private email list, which will be a great tool for you as well, because I send out extra tips as well as invitations to live streams where you can ask me questions while I'm doing a live stream. So I think that's kind of a cool option. And then I also can provide you with a free coaching session. I have a calculator that I've developed that can kind of look at your numbers and kind of spit out some data based on what your goals are and kind of look to see if a HELOC is a good fit for you. Also to just see what you can do financially to improve your situation or meet some goals that you may have. So send me an email at couplescreatecashflow@gmail.com if you'd like to set up a free coaching call. All right, let's jump into the content. What in the world is a HELOC? We've covered this on another video or two, but I just want to briefly look at it in case somebody is just looking at this for the first time. A HELOC is a home equity line of credit. It's provided through a bank or a credit union, and it's based on the value of your house. And usually the lender will provide you up to 90% loan to value, and interest rates usually float with the prime rate, so they can go up and down. It can be kind of scary for someone who's really focused in on a particular number for the interest rate. But this interest is not really calculated the same way that your mortgage would be. It's simple interest focused on a daily balance. So the quicker you put money in, the lower the interest cost is for the month. And you don't have a monthly payment. So it's not like a mortgage where you have a monthly payment you have to pay every single month for the entire term. You have a very flexible repayment plan, which allows you to use that to your advantage and put your paycheck into the HELOC, reduces your interest costs. And actually, even if you have a 5 or 6 or 7% interest rate, the effective amount of money that you pay can actually be closer to 2% or 3%. So we're going to jump into, a HELOC also makes your equity in your house liquid. So if you have been paying down your house for a while and you still haven't paid it off, you still have a monthly payment and you can't access any of the equity you paid into that mortgage until after the whole thing is paid off. And even then, well, actually, no, you can't get the equity out either way, right? Once you paid your house all the way off, the only way to get the equity out is to either sell it or do a cash out refinance or get a home equity loan or a line of credit. So I personally don't want anything to do with a second position home equity loan, because as I pay it back, I don't have any access to the equity. What I always want to look for is a home equity line of credit so that as I pay it down, I actually have access to the funds again. I can use them over and over again. And this way I can actually tap into some wealth that I've been building over time by paying down my home mortgage without actually having to go out and take any big risks in the stock market or anything like that. I can just literally tap into some frozen money that otherwise would not be usable. So I'm leveraging the funds that are in the HELOC. I'm going to pay large chunks of money towards debt. And then my paychecks are going to get direct deposited into my HELOC. And that reduces how much interest I owe as soon as the deposit is received. So again, it's a daily balance. So on the day my paycheck goes in, it reduces my balance. And the interest rate that is charged to that balance is going to be the annual rate divided by 365 days. They're going to do that every single day, and then they're going to add up all the interest costs for the month and charge me one interest cost for that month. And whenever I make a deposit after that's due, it'll just remove that amount from my payment. So for example, if my interest cost for a month was exactly $100 and I got a paycheck for $1,000, it would be like having a deposit of $900. They would take the $100 for the interest payment first, and then they take the $900 afterwards. Well, they wouldn't take it, sorry. They would deposit the $900 afterwards. All right, so then we look at, well, how do we do velocity banking? Because that's really the term that a lot of people use to really describe using the HELOC, putting your paychecks into the HELOC, sending most of your expenses through the HELOC, and doing this debt repayment strategy. So what we can do is we can look at what is your monthly cash flow. This strategy really relies on having extra money every month. The more you have, the bigger the chunk you could put into the HELOC, because really the strategy is about reusing the money in the HELOC. So you take your cash flow from each month, you multiply it by 12, and that would kind of be the maximum amount of money you'd want to put down on any one chunk payment towards debt. There's also the 2/3 rule, which would be looking at the 2/3 of your limit. So let's say you had a limit of $30,000 on your HELOC. You would only want to ever use 20,000 of that 30,000 so that you allow yourself to have a little bit of a gap, a little bit of a cushion, and it helps your credit score because you're not maxing out your debt. So there is a term in the credit world, they're looking at your utilization of your debt limit. So you just want to show that you're not maxing it out. All right, and then here we go. We're going to jump into the case study because I know people want to look at the actual numbers. So let's say that we have a 30-year-old married couple and they own a home, and the value of the home is $400,000. They have a mortgage of $285,000, and they're making a monthly payment of $1,775. Their interest rate is 3%, and so that is a major cost for them each month. They have a car loan for $3,500, and that monthly payment is $115 a month at 4%. They also have some student loans left over, some $12,000 towards student loans at a 6% interest rate, monthly payments being $240. They also have a credit card that has $4,500 on it, and they have a $125 minimum monthly payment, and that's going up at 20% interest. These are the debts that they have. These are the things that they would like to get rid of so that they can have more money to use for their finances, for their plans for the future. All right, so let's just look at some major numbers. And these numbers are something that, I would suggest you look at for yourself. What's your income? What's your expenses? So then your income minus your expenses is your cash flow. So when you're looking at your annual cash flow, you take that number and multiply it by 12. In this case, the cash flow is $325. Total debt, $305,000. We added up the mortgage, the car loan, the student loans, credit card. And the monthly debt payments are $2,255, roughly a third of their total expenses. All right. So when we are going through the process of starting velocity banking, we do have to follow some steps. We got to know our numbers. We got to make sure that cash flow is positive. If cash flow is not positive, getting a HELOC will not help anything. You need to make sure you have some money left over after you pay your bills every month. If you're struggling with that step, then my goal for you would be get in touch with Dave Ramsey's material, look at how to be frugal, scrimp, and save, and get to the point where you can manage your budget. He's got a lot of good material for that. Step 2, check your home value and what the 90% loan to value would be to see if a HELOC is a good option. Step 3 would be acquire the HELOC if possible, if it's a good fit for you, and then start velocity banking. So let's look at each step. The first step is to make sure your cash flow is positive. This couple will meet together, they talk about their budget, and they figure out that they could actually cut some spending. They find $200 a month that they can eliminate because they really want to focus with intensity on getting their debts fully paid off. They know that if they can free up $200 each month, even if it's not very fun, $200 would go a long way to making this debt go away. So we're going to say their old expenses were $6,800. Their new expenses are $6,600. Their old cash flow was $325 a month, and their new cash flow is $525. Second step, we got to check our home loan to value and see if a HELOC is a good option. So the home value is $400,000. The mortgage is $285,000. A HELOC is looking at a 90% loan to value. So 90% of $400,000 is $360,000. So then if we take the $360,000 and we subtract how much we have for a mortgage right now, then we would be left with $75,000 as kind of that max HELOC limit. So the max HELOC limit is not a guarantee of what the credit lender will give you or what your limit will be when the bank kind of looks through your file and looks to see if you're a good fit. They're going to want to make sure you have a good credit score. They want to make sure that you have income. They're going to probably want to see some pay stubs. They're going to want to do an appraisal, that sort of thing. So they are probably going to really be focused on, are you a good fit to have a HELOC? If you check out with all of that, $75,000 would be the max you could get based on a 90% loan to value. Okay, so as we look at step 3, now we're looking at how do we get access to that HELOC? I do have that HELOC checklist as part of the 3 steps to start velocity banking guide that you can download in the descriptions below. Use that checklist to record which banks and credit unions are the best fit for velocity banking. Do some Google searches. Find some banks, credit unions that are offering HELOCs. Maybe they'll even find one that has an introductory offer where they have a lower interest rate for the first 6 months or 12 months. That would be a great fit for this kind of strategy. And then you got to call up the bankers and talk to them. See if you can figure out exactly what terms and conditions go with this HELOC. And like I said, I've got that checklist as part of the guide that has those questions on it. So if you're wondering what those are, please just for free download the checklist and get that information in your hands. Really helps when you're talking to a lender. And then apply to the HELOC. You're going to need to give them the pay stubs. You're going to need to have them come out and do an appraisal. It might cost you $500, but they want to confirm the house's value. Perhaps the value is higher than you expect it to be. Sometimes when you go on Zillow or some other website to figure out your house's value, it's not necessarily as accurate as what the bank's appraiser will find. So in this case, let's just be conservative and assume that this couple gets a $60,000 HELOC. Okay, here's the opening moves. It's kind of like a chess game. You need to have a strategy. If you just jump right in, you're going to find out that it can very easily get out of hand. The first step is to think about what is your first chunk target and how much are you going to put towards it. The target really should be the one debt that has the highest interest rate or has the lowest balance or has the highest monthly payment, because you're trying to improve your cash flow with these moves. You really want to see if you could pay a debt off completely so that you can free up how much monthly payment you would be paying towards it and keep that monthly payment as your cash flow, which then pays back the chunk faster. We also want to look at the 2/3 rule, and we want to make sure we don't ever go above 2/3 of our credit line. So in this case, the 2/3 rule is $40,000. So we want an annual cash flow rule of $6,000 to be less than the 2/3 rule. And in this case, it is. So we take our $525 per month, multiply it by 12, there's our 6,000. Okay, so as long as we've checked that our $6,000 is less than our 2/3, we're good to go. Now, I just said $6,000, but if we look at the first chunk, we could actually apply $8,000 towards the first debts. We could use 8,000 instead of 6,000 and actually free up $240 more per month. Okay, so when we add up the car payment and the credit card, $240 get freed up. So immediately when you pay those off with the $8,000 chunk, you have $240 more per month. Well, that means your new cash flow is $740 instead of $500, and now you can actually pay off that balance in less than 12 months. That $8,000 payment will roughly pay off in 11 months. I don't have the exact numbers for you, but just be aware, 11 months, that's where we're at. Now, step 2, you got to set up direct deposits of your paychecks into your HELOC. So a lot of times the reason why velocity banking works is because as soon as your paycheck hits your bank account, it helps lower your balance. When you are not operating with a HELOC, you have to keep a certain amount of money in your checking account to cover for your expenses. But if you run your expenses through your HELOC and your paycheck hits it right away, you're actually not really getting as much interest as you may think. And then set up as many automatic payments on your expenses through a cashback credit card as possible. Whenever you pay on a cashback credit card for things that you normally would pay for, now we're not talking about extra things, but if you know every month you're paying a certain bill and you can pay it on a credit card and get 2 or 3% cash back, you can save a little money that way. And then you can also delay when you actually have that money leave your bank account by 15 days sometimes, 20 days sometimes, depending on when your credit card is due. And then take those cashback rewards as statement credits so that you can reduce the balance without it coming out of your HELOC. So your goal is to get income into your account as fast as possible and take outflows out as late as possible, so you have a lower daily balance. Here's your chunk 2. After 11 months, your HELOC balance is close to 0. In a HELOC, you don't actually want to get back to 0. You want to get it close to 0, but just think about it this way. If you're receiving your paycheck into your HELOC and you don't have a balance, you're not going to get your paycheck. You can't have a positive balance in your HELOC. So you have to be doing your chunk early enough so that if your paycheck comes in, it doesn't get bounced back to your employer. And I know that's going to feel really weird because normally you wouldn't get a paycheck to bounce. It would usually be your payment to be bouncing. But in this case, you do want to have a balance on your HELOC. So you have to look at what the next chunk is going towards. You're looking at an annual cash flow of $8,880. If you were to pay off your student loan, you would need to put $11,000 down, because over this last year, you've been paying on that student loan and the balance has gone down. And so if you actually made an $11,000 payment on your student loan, you would raise your annual cash flow from $8,880 to $11,760. So in this case, we're going to actually increase our chunk because of the cash flow that it creates in the process. When your balance gets back down close to 0, which is after 11 or 12 months, the only debt that's left is the mortgage. So here's the time when you need to either send payments to the mortgage to keep paying the mortgage down, or start investing in some cash flowing assets like real estate. Because like I said, you don't want your balance to get completely to 0. So you're going to have to figure out where to use that capital. And in my opinion, you want to buy something that's going to be a cash flowing asset. And you may not actually want to pay off a house if it's at 3%. Now, if you pay off your house with your HELOC, so think about it this way. Let's say by this point in time, you have some more equity, right? When you applied, you could get a $60,000 HELOC. Well, as you've been making mortgage payments, you've actually freed up more equity. If you were to go apply for a HELOC again, you might be able to get a $90,000 HELOC. If you use $90,000 towards your balance on your loan, on your mortgage, you'd create more equity, even though you have a higher balance in your HELOC. So what some people will do at this point is take their annual cash flow and chunk it at their mortgage, and chunk it at their mortgage, and chunk it at their mortgage, and just do that because it'll actually speed up your home repayment process. And it's a lot safer than using extra cash because you don't have to retain a certain amount of money for unintended expenses, because your HELOC has a credit limit to it, a line limit that you could actually spend for emergencies if you needed to. And life does happen, right? Like we run into issues, cars break down, appliances break down, people get injured or hurt, and we need to have some extra money on hand. But when you have a HELOC, it's easier to deal with consequences of emergencies or unexpected things, and you don't have to necessarily have as much money on hand. So, as I said at the beginning, I want to help you. I have a 3-step guide to start Velocity Banking. It's going to be linked up in the description below, and it has a checklist for vetting your HELOC options. It's literally all the questions you'd want to ask a banker. And then it's got 4 copies of that, so you can compare 4 different banks right on the checklist. You'll also be able to then be on my private email list. I will be sending out freebies, invitations to live streams, whatever new things I create, you'll be the first people to know. And then if you want to try to access a free coaching session, feel free to send me an email. Jordan is my name, Jordan Johnson, at couplescreatecashflow@gmail.com. I have a spreadsheet that will give you some tools and some ideas of where you're at, a snapshot of where you're at financially, and then we can talk about what your goals are and see what the next steps could look like. So thanks for watching, and just let me know if there's any way that I can help you.